Hello, today is Wednesday, March 10th, 2021, and thank you for joining me for another edition of the Market Commentator Podcast. My name is Andy Wilms, and I am the President and CEO of the Milwaukee Company. Joining me this morning is Dan Dujmic. Dan has been on our podcast previously, and as you may recall, he is a principal in the Taxed Fixed Income Department at Piper Sandler Co, which was formerly known as Piper Jaffray. Today, Dan and I will be discussing strategies of investing in bonds in a rising interest rate and inflationary environment. But before we get started, I want to remind our listeners that this podcast is for informational purposes only, and listeners should conduct their own independent research before acting on any information or opinions expressed during this podcast. And the views expressed in this podcast are Dan and my personal views, and not those necessarily of the Milwaukee Company or Piper Sandler. And with all of that, I'm going to say hello, Dan. Good to have you back.
Well, good to be back. I must have done a decent job the last time to be invited back to your fantastic podcast. So I'm happy to be around today.
Well, you did do a great job last time, Dan, and I'm looking forward to more of the same this morning. So we're going to be talking about bond investment strategies today, and I guess we should get some of the background information settled first. And the most fundamental point being, what is the difference between an active and passive bond investment strategy?
Well, that's a great question, Andy, and it's probably a great question to lead this podcast with, because it starts off at a very high level. Passive management is similar to buying into the S&P 500, where you're essentially buying the market. You're not really doing any security selection per se. Okay, with active management and passive management in bonds, it really refers to a couple of things. Passive management would be buying one security, let's say out 10 years, and letting that security mature. That's it. You're not managing on an ongoing basis that security. You're essentially buying, and I hate to use the word forget, but you're buying, holding to maturity, letting it mature, and then doing something with those proceeds at that time. In active management, which is essentially a more hands-on role by the individual investor, requires the rebalancing of multiple securities over time, rather than buying just one security. And I want to add one other thing. Passive management would also be giving control to somebody like a money manager or a mutual fund or an ETF to invest a portion of your fixed income allocation in. And it's active management from the manager's point of view, but it's actually passive management from the investor's point of view, because you're giving up control of that process to someone else.
Okay, so I often think of it in similar terms, but generally sort of describe passive strategies kind of a buy and hold strategy with the objective for buying the bonds is income generation and diversification. That is, it's part of a stock and bond portfolio where the bonds are being bought to diversify equity risk. And with active strategies, as you pointed out, you're more engaged in the buying and selling of bonds. So in addition to income generation, you're trying to generate capital gains. And by capitalizing on profits made by the actual trading of the bonds because of changes in interest rates or yield curve shifts or changes in credit rating. So you're really the active bond and strategies are striving for greater returns than you would otherwise get in a passive strategy.
That's correct. That's correct, Andy. Essentially, you bring up the concept of total return, which is obviously important in the investment field. And the total return is typically in bonds is composed of three components: the reinvestment return from reinvesting the coupons, the income itself that you receive from the bonds, and as you pointed out very well, the capital appreciation or depreciation of selling that security early, et cetera.
Right. And you brought up you started to mention, package products like ETFs and mutual funds, and how do they compare? So we all know that you can buy a bond fund that tracks an index, or you can buy a bond fund, whether that be an ETF or a mutual fund that is actively managed, right? You can have a passive bond strategy or an active. Why do you think? What are some of the pros and cons in your mind of investing in individual bonds versus a bond fund?
Excellent question. Again, I'd like to start off just talking about kind of the mutual fund, exchange traded fund component of the fixed income arena. And essentially, what happens is in any fixed income security, when rates rise, unless it's a floating rate security, the value of the bonds tends to fall. A challenge in the ETFs and the mutual funds is that there's no set maturity date. So if you buy at an asset value of X and interest rates rise, then net asset value could be lower than your purchase price for a long, long period of time. In many cases, it might be longer than if you would have bought. It may be at a depreciated point longer than if you would have bought an individual bond. So unlike individual bonds, mutual funds have no set maturity date. So you have no guarantee of having the full value of your principal return. From a individual bond basis, it's just the opposite. I have a bond. It has a set maturity date. I know as long as, let's, for example, if it's a treasury security, I know that I'll get my money back because the U.S. government's the highest rated credit in the world, as long as I hold to maturity. I know that for a fact. I don't always know that if I'm in a mutual fund or ETF.
Right, and that's exactly right, Dan. So in a rising rate environment, as we have now, buying a individual bond with a fixed maturity date can provide investors with a greater degree of peace of mind, and that's exactly why those of my clients who are listening to the podcast today will recognize my having told them that in the past, and us having been migrating or putting a greater emphasis, I should say, on individual bonds for the last year or so.
I'd like to add one other item, Andy. People say, what is kind of the threshold for buying an individual bond? In theory, many bonds are available in $1,000 increments. I would say if you've got a few $1,000s, it's probably best to put that into a mutual fund or an ETF that has a fixed income exposure. But if you're a high net worth individual, that's got tens of thousands or hundreds of thousands or millions of dollars, you can set up a bond portfolio using individual bonds. And I usually recommend minimum of $10,000 for an individual bond from my past experience.
For each bond position?
For each bond, correct.
Right. Yeah, I think that makes sense. And I usually tell clients, you want to have at least 5 or 10 different issues for diversification in a bond portfolio. So if you're going to buy individual bonds, and you want the portion of your portfolio that you're allocating to fixed income investments to probably be in the neighborhood of at least $100,000 or so. That's sort of where I look at it.
I agree.
The other thing I do want to mention, though, is not all bond ETFs are the same. When we talk about bond ETFs that do not have a maturity date, we're talking about what's called a perpetual bond fund, where the bond fund has a target date, a target duration of, let's say, 7 years. And so it buys and sells bonds continually so that the average term of that bond fund is 7 years. There are now what you would call defined maturity date ETFs, which do have a maturity date, where they buy bonds that all mature on the same date or a very similar date.
Sure.
So they might all the bonds might have a maturity date, let's say, of 2027, and so all the bonds in that fund will mature on or before the fund's maturity date, and at that date you get your money back. So you do have that security of getting your money back, provided that the bonds in the fund don't default. And because these funds hold many, many bonds, thousands and thousands of them, default risk is probably much less than you would have in a typical individual bond portfolio. But regardless of whether we're talking about individual bonds or bond funds, you're going to want to manage those bonds based on some sort of strategy. Just simply ad hoc buying bonds based on what looks good at the moment is not a good idea, I don't think, in either of our minds. So let's talk a little bit about, and there are both active and passive bond investment strategies. And it would be helpful, Dan, if you could talk about some of the major types of passive bond investment strategies that either a fund manager or an individual investor might use.
Sure. Within the individual bond arena, there are two active strategies that your investors can take advantage of. One of them is called a laddered portfolio strategy. And if you don't mind, I'd like to take a brief minute or two and go over that. So what is a bond ladder? Bond laddering strategy involves buying bonds with different maturity dates so the investor can respond relatively quickly to changes in interest rates. The laddered bond portfolio investing strategy is really kind of the formal name for it. It focuses really on diversifying the portfolio by purchasing fixed income securities with different maturity dates in a ladder-like fashion. If you think of a ladder with its sides and its rungs, okay, the rungs or the steps are the different maturity dates. The diversified portfolio, this is really a diversification technique, not necessarily for industries like maybe in a stock portfolio or different sectors. It's really a way to diversify maturity risk. And the diversified portfolio, bond ladder portfolio, helps mitigate risk of short-term bonds one at a time as they mature, then reinvests the principal in longer maturity securities at the end of the ladder. So simply means as your shortest security comes due, you reinvest at the end of the ladder. What this does, Andy, is it reduces reinvestment risk associated with rolling over maturing bonds into similar fixed income products all at once. It also helps your clients manage the flow of money, helping to ensure a steady stream of cash flows throughout the year. So a bond investor might purchase both short and long-term bonds in order to disperse the risk along the interest rate curve. This is if the short-term bonds mature at a time when interest rates are rising, the principal can be reinvested into higher yielding bonds. So to bring up your point, Andy, earlier, is how do we set up strategies in the environment that we're in currently now, where we're seeing rising interest rates and they may continue to rise as both fiscal and monetary stimulus enter the economy.
Right. So just to reiterate a little bit what you said. So with a bond ladder, we might buy bonds. We might have a portfolio of bonds. Let's say with 10% in bonds that mature in 1 year, 10% that mature in 2 years, 10% in 3 years, and so on. And then as the 1 year bonds mature, then the 2 year bonds drop down to a 1 year bond. The 10-year bonds drop to a 9 year bond, and the proceeds from the matured 1 year bonds are rolled into the new 10-year bonds. And the idea here, because the idea here is to hold on to the bonds till maturity, no matter what happens. In that regard, it's a passive strategy because you're not planning to trade bonds to trigger capital gains. You're simply holding on to them until they mature and then buying new bonds at the far end of the ladder and so on and so forth. And as you said, that it works great to kind of minimize risk in terms of changes in interest rates or inflation driven changes in interest rates, because you're going to have 1/10 always maturing. So you're kind of dollar cost averaging in a sense. You're always reinvesting at the current interest rates. And if interest rates go up or down, you're sort of averaging over time the interest, the income you'll get from the total portfolio. But that's so clearly bond laddering is a very attractive way to manage a bond portfolio. But another one that also has some unique advantages is the barbell approach. Why don't you give us a rundown on that?
Absolutely. So a barbell strategy, unlike a laddered strategy, involves the purchase of short and long-term bonds, but really nothing in between. So this creates a shape like a barbell that a weightlifter would lift over his head. And why is this strategy effective? Essentially, the barbell strategy attempts to get the best of both worlds by allowing investors to invest in short-term bonds, which takes advantage of current interest rates, while also holding long-term bonds that pay higher return when the yield curve is steep. Talk a little bit about the steepness of the yield curve. What that means is that is the difference in return between the short end of the yield curve and the long end of the yield curve. And the typical measurement that we use in our business is the 2-year versus 10-year Treasury spread. And this spread is about 1.3% right now in the market. And to give you some reference on how steep that curve is, that means the compensation for duration is higher than it has been recently. That curve going back to 1976, per the Bloomberg data that I have, averaged about 90 basis points. So we're about 40 basis points more in steepness or compensation for duration than we've been historically going back many, many years to the mid-1970s. So when the yield curve is steep, the barbell strategy works well. When it's flat, it does not, especially if you think the yield curve is going to get steeper. Now, this is important. If we think the government, through fiscal policy, and the Fed are going to be extremely accommodative and not restrictive, the yield curve will continue to steepen and will make barbell strategies more effective. So if interest rates rise, the bond investor in a barbell strategy will have less interest rate risk, since the short-term bonds will be rolled over or reinvested into new short-term bonds at higher rates. The strategy really helps market value risk in a rising rate environment while still having exposure to higher return long-term bonds. So the long-term bonds give an investor a steady flow of higher yielding income over the term of the bond. However, though, by not having all of your capital in long-term bonds, this limits the downside effect if interest rates were to rise. So if you remember, one of the topics, or I think it was the primary topic, is how do we invest in the rising rate environment? And you want to implement this strategy when there are large gaps between short-term and long-term bond yields when the yield curve is steep.
I agree entirely. The one thing that that listeners need to consider when they're implementing a barbell strategy is, how do you keep it going? In other words, with the ladder, it's very easy. When the 1-year bonds drop off, the 10-year bonds become 9-year bonds, and you use the proceeds from the 1-year bonds that have matured to buy the 10 years. It's just, you can go on and on and on. It's a never-ending cycle. With a barbell, that's a little tougher, because your short end of your bonds are maturing, and if interest rates are rising and you want to invest those proceeds in new bonds with a little more interest at a higher yield, it may end up buying some of the middle bonds that the barbell was designed to initially designed not to invest in. So it's not as permanent of a strategy, but that's okay, because you don't expect interest rates to go up forever either. So at some point, you might want to convert your barbell into a ladder, for example.
I actually think the barbell is an effective strategy in the current environment that we're in, but your point is well taken. The barbell requires frequent rebalancing versus the ladder is a little easier to rebalance and stay disciplined in. Without active management of the barbell strategy, the investor is at risk with ending up with only long-term bonds, which have greater exposure to interest rate risk than short-term bonds. So it's effective, but requires someone to really keep an eye on it and stay disciplined and not end up buying longer bonds and really disqualifying the barbell as an effective strategy.
Exactly right. So, and by the way, I have been using a barbell strategy periodically for my clients, and still am at times, but and that's what makes me sensitive to the amount of management that's required to implement a barbell strategy effectively. But let's talk now and maybe wrap up with the discussion. You brought up the fact that we are trying to give our listeners some ideas on how to invest in bonds in a rising rate environment. I guess the first point I'd like to make is that bonds remain an important part of a portfolio, even in a rising rate environment, notwithstanding that, or I should say in an inflationary environment. Usually kind of go hand in hand, but because even though when you have inflation, the income earned by the bonds has less value because its purchasing power is reduced, you still need to have the stability and diversification benefit that bonds offer, and that is very hard to find in other asset classes without taking different types of risk. So let's talk a little bit. Okay, if you're an investor who wants to maintain an exposure to bonds in this in an inflationary environment, how might you go about it?
That's a great question as well, and it's really relevant in the environment right now where I think the term inflation is being discussed more and more, given the dramatic stimulus both from the monetary and fiscal side, as we've discussed. There's a couple ways to do this. For individual investors, they can invest in a fund that has what are called Treasury inflation protected securities. And so these securities are Treasury credit quality, but the way that they work is they're designed to help investors protect against inflation. So they become really a popular assets for protecting portfolios from inflation, as well as profiting from it, because they pay interest every 6 months based on a fixed rate determined at the bonds auction. However, unlike a traditional fixed income treasury or security where the fixed payment is fixed, it's the same over the life of the security, the interest payments can vary since the rate is applied to the adjusted principal or value of the bond. So if the principal amount is adjusted higher over time due to rising prices like inflation, the interest rate will be multiplied by the increased principal amount. So in a nutshell, when you buy a fixed income bond, inflation rises, your payment's fixed, so inflation erodes the value of that payment every 6 months or however often it's paid. With a Treasury inflation protected security, that is somewhat offset because of the way that the security is designed. These securities are issued with maturities of 5, 10, 30 years and considered low risk investments because they're US government backed from a credit quality. So at maturity, the TIPS return the adjusted principal or the original principal, whichever is greater. This is an important component, Andy, for your listeners to understand, because you can't lose your original investment. You could get back the same amount, or you could get something. And, you know, the question I get asked a fair amount, should I buy a bond fund or individual securities in these? They're available from a lot of different sources on an individual basis, or you can buy them in terms of a fund. It's really up to you how actively you want to manage that portfolio.
You know, I'm a big fan of tips on occasion. I've actually talked to the Wall Street Journal about them at one time because I was buying such large amounts of tips for our client portfolios a few years back. And I've been an active investor in tips now for last year or so. And then the neat thing is that, you know, what's called a nominal bond, your traditional bond, the face amount is what it is, right? If it's a face amount of $10,000, it's always going to be. But with a tip, the face amount increases if inflation goes up. So you might end up with at maturity with a face amount of $12,000 or $13,000, but it can never go below the 10. So that's a really good thing, as you just pointed out. And another thing I kind of find interesting way to hedge against monetary inflation from a declining dollar is to consider high quality international bonds. Now this is a little trickier, but because of the change in, you know, exchange rates, international bonds can actually provide a hedge against inflation when it's due to the dollar declining in value, which is a real risk, I think, at this point in time, given the great amount of stimulus being approved in Washington. And of course, the more dollars there are, the greater potential, greater questions are raised about the value of the dollar, especially when GDP doesn't keep pace with the growth in GDP doesn't keep pace with the number of dollars in circulation. You have basically more dollars chasing the same amount of goods. The value of the dollar, you're going to have inflation, and the value of the dollar is going to potentially decline.
Absolutely.
So, all that being said,
I'd just like to add one more thing on the inflation-protected securities. Think of it as insurance. Insurance is always cheapest when you don't need it. So one of the challenges is the financial press will tout tips usually at the wrong time to buy them. Yep. So if inflation is accelerating, it's too late, in my opinion, for the tips to be effective because they've already priced in the inflation. This is going to sound somewhat backwards, but I'm going to say it, is the best time to buy tips is when inflation's non-existent, because you're buying the insurance at the cheapest valuation that you can. So I just want your listeners to keep that in mind.
Right, and that makes me feel good about our decision to start buying them a year ago. And right now, even still, inflation is pretty low. I mean, we've seen some uptick in inflation, but it hasn't been terrible right now. But if you're buying bonds through a TIPS ETF, it can be more costly now because of their popularity of this type of ETS has surged, which has pushed their prices up higher. Buying individual TIPS may be a more attractive alternative in this market, but it's again, as you well said, it's a type of decision that needs to be tailored to each and every investor. And you and I would be happy to talk to anybody who has questions about it if they want to reach out to us. What's best for. So with that, Dan, I think I'll wrap it up today. So, but I want to thank you again for joining me, and really enjoyed having you on the podcast, and look forward to having you back.
Absolutely. Thank you for having me, and we'll talk soon. Thank you again.
And before I close the podcast, let me remind our listeners, I should say, that you should not act on anything you have heard in this podcast until you have discussed it with a qualified financial professional who is familiar with your personal situation and your investment objectives. And with that, I'll say thanks again for joining us, and have a great day.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.